The AI revolution is creating millionaires faster than any technology shift we've seen before, but recent market turbulence has knocked down even the strongest players in the space. Nvidia has plummeted over 22% year-to-date, while Broadcom is down nearly 22% in the same period. When market leaders get hammered this hard, it creates extraordinary buying opportunities for those willing to look past the short-term noise. The current correction in AI stocks might just be the perfect chance to position yourself for the next major upswing in this unstoppable technological transformation. Today, I'll show you exactly which AI stocks to buy now while they're trading at what could be their deepest discounts of 2025. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. Why the recent AI market correction has created rare buying opportunities. The top AI semiconductor leaders currently trading at compelling valuations. Software and platform companies leveraging AI to transform industries. ETF options for broader AI exposure with lower risk. And of course, my complete analysis of which AI stocks to invest in 2025 for potentially massive returns. Let's start by understanding what's happening in the AI market right now. The artificial intelligence revolution isn't slowing down. It's accelerating. According to our data, the global AI market is projected to grow at a compound annual growth rate of over 30% through 2033, essentially 11 times in size over the next 9 years. We're seeing unprecedented adoption across every industry, from healthcare diagnostics to autonomous vehicles, cloud computing, and enterprise software. So why are AI stocks getting hammered? Several factors created this perfect storm. Donald Trump's administration announced 25% tariffs on imports from Canada and Mexico, while raising tariffs on all Chinese imports from 10% to 20%. This spooked investors about global supply chains, especially in semiconductors. Additionally, companies like DeepSeek released breakthrough AI models requiring less computational power, raising concerns about future chip demand. And when Jensen Huang sold $14 million of Nvidia stock daily last summer, headlines created unwarranted panic, despite this representing less than 0.5% of his total holdings. This disconnect between short-term market sentiment and long-term fundamentals creates the rare opportunities we're seeing today. The AI stocks' bubble fears appear greatly exaggerated when you examine the actual growth trajectories of these companies. Let's dive into the specific stocks that look particularly compelling right now. Now let's look at the hard numbers behind these potential bargains, starting with Nvidia, the undisputed hardware leader in the AI revolution. Nvidia has experienced a dramatic 22.72% decline year-to-date according to our latest data, despite showing remarkable growth fundamentals. The company's trailing PE ratio has compressed to approximately 37, significantly below its 5-year historical average of 79. More importantly, its forward PE has dropped to just 24 to 25 based on FY26 estimates and even lower to 21 to 22 based on FY27 projections. This rapid multiple compression suggests the market is overlooking Nvidia's projected 52 to 54% revenue growth for FY26 and sustained earnings growth of 25% plus annually over the next 3 to 5 years. When a company with market dominance, 70 to 98% share in AI data center GPUs, trades at these multiples despite explosive growth, it warrants serious attention. Broadcom presents a similarly compelling case, having fallen 21.83% year-to-date, despite projections of 21% revenue growth for FY25 and EPS growth around 35 to 36%. Their serviceable market for AI chips is expected to reach $60 to $90 billion by FY27. While its trailing multiples appear high, the forward PE of 28 to 34 is reasonable for a company transformed by the VMware acquisition and experiencing 40% plus growth in its AI revenues. Meta Platforms has pulled back 9.97% year-to-date, creating a particularly interesting opportunity. With a forward PE of approximately 20 to 22 and a PEG ratio between 0.85 to 1.0, Meta is priced more attractively than many peers despite expected revenue growth of 13% for FY26. The company's massive investments in AI infrastructure, $60 to $65 billion capex in 2025, and its Llama open-source AI models position it uniquely in the ecosystem. CrowdStrike has bucked the trend with a 20.25% gain year-to-date, reflecting its critical role in AI-powered cybersecurity. Despite its premium valuation, forward PE above 100, the company targets reaching $10 billion in ARR by FY31, implying a sustained CAGR above 20% for the next 5 to 6 years. Nvidia, the AI compute leader. Competitive position. Nvidia maintains a commanding 90% market share in AI accelerators despite mounting competition. AMD is trying to capture market share with its MI300 series accelerators, while Intel competes with its Gaudi AI accelerators. Major hyperscalers, Google, Amazon, Microsoft, Meta, are developing custom AI chips, but Nvidia's comprehensive hardware-software ecosystem through CUDA creates a significant competitive moat. Its dominance extends beyond hardware. The CUDA parallel computing platform and associated software libraries create enormous switching costs, reinforcing its leadership. Opportunity assessment. Nvidia's 22.72% year-to-date decline has created a rare entry point for the dominant AI chip leader. With its Blackwell architecture promising 4 times improvement for training and 30 times for inference compared to Hopper, Nvidia is poised to maintain its technological edge. The company's projected earnings growth far outpaces its current multiple, suggesting significant potential upside if execution remains solid. Even if market share erodes somewhat, the massive overall growth in AI compute demand provides enormous runway. The forward PE compression to 24 to 25 and 21 to 22 for FY27, while maintaining 25% plus long-term earnings growth, makes this potentially the most compelling opportunity in the AI space right now. Broadcom, the AI infrastructure enabler. Competitive position. Broadcom occupies a different but equally critical position in the AI value chain, focusing on connectivity rather than core compute. With approximately 80% market share in high-performance networking, silicon essential for AI data centers, Broadcom provides the plumbing for AI infrastructure. They also design custom AI accelerators, ASICs, for major hyperscalers like Google. The VMware acquisition further strengthens their position in managing complex AI workloads across hybrid environments. They face competition from Marvell, Nvidia, Mellanox, Cisco, and Arista Networks in networking, but maintain significant technological advantages. Opportunity assessment. Broadcom's 21.83% year-to-date decline presents a compelling value proposition. The market seems to be underappreciating the synergistic growth potential from the VMware integration and the sustainability of its AI-driven semiconductor growth. If management successfully executes the integration while capitalizing on the expanding AI infrastructure market, particularly in networking and custom silicon, current prices could prove highly attractive over a multi-year horizon. With AI revenues projected to grow 40% plus in FY25 and a forward PE of 28 to 34, reasonable for a transformed business, Broadcom offers a differentiated play on AI infrastructure that doesn't rely solely on GPU compute trends. Meta Platforms, the social AI powerhouse. Competitive position. Meta's competitive advantage lies in its massive scale, billions of users, powerful advertising engine enhanced by AI, and strategic positioning with its open-source Llama models. While facing competition from Google, TikTok, and others in social media, and from OpenAI, Microsoft, and Google, in the LLM space, Meta's differentiated open-source approach could prove highly valuable long-term. Its AI is deeply integrated across operations, powering ad targeting, content recommendations, and soon a conversational AI assistant targeted to reach over 1 billion users. Opportunity assessment. Meta's valuation is perhaps the most intriguing relative to peers. Its 9.97% year-to-date decline has brought its forward PE to around 21 and PEG ratio near 0.9, extremely attractive given the company's scale, profitability, and AI investments. The market seems overly focused on the costs associated with Meta's long-term bets, AI infrastructure, metaverse, and regulatory challenges, potentially undervaluing the strength of the core advertising business, which continues to benefit from AI enhancements. If the core business remains robust and either the Llama ecosystem or metaverse strategy proves successful long-term, the current price could represent a significant discount to intrinsic value. CrowdStrike, the AI security guardian. Competitive position. CrowdStrike leverages its cloud-native, AI-powered Falcon platform to maintain leadership in endpoint detection and response. The company faces competition from Microsoft's Defender suite, Palo Alto Networks, SentinelOne, and others, but its early AI-native approach provides an edge in addressing modern cyber threats. CrowdStrike's AI is not merely an add-on but fundamental to its architecture. Its threat graph processes trillions of security events weekly to enable real-time protection. Recent innovations include AI model scanning to detect malware in AI models and AI-powered threat detection for cloud security. Opportunity assessment. Despite its 20.25% gain year-to-date, CrowdStrike's long-term opportunity remains significant. The company targets reaching $10 billion in ARR by FY31, implying a sustained CAGR above 20% for the next 5 to 6 years. Its total addressable market is expanding rapidly, estimated at $116 billion and projected to grow to $225 to $250 billion by 2028-2029. However, its premium valuation, forward PE above 100, makes it less of a deep discount play compared to other names on our list. The investment case here depends more on continued execution and market leadership than valuation mean reversion, making it potentially appropriate for investors seeking growth at any price rather than value. ETF Options, diversified AI exposure, competitive position and opportunity. For investors seeking broader exposure to the AI revolution, ETFs offer compelling alternatives to single-stock risks. QQQM, Invesco Nasdaq 100 ETF, has fallen 9.15% year-to-date, despite providing substantial exposure to major AI players with its top holdings including Nvidia 7.40%, Microsoft 8.12%, and Apple 8.81%, at a competitive 0.15% expense ratio. The specialized XAIX, Xtracker's Artificial Intelligence and Big Data ETF, is down 6.36% year-to-date, offering more targeted exposure to the AI theme. These ETFs allow investors to participate in the AI revolution without trying to pick individual winners, which can be particularly valuable in a rapidly evolving technology landscape. QQQM's concentration in tech leaders, top 10 holdings comprising 49.17% of assets, provides significant AI exposure while maintaining some diversification benefits. While these opportunities look compelling, understand the key risks. Nvidia faces intensifying competition and regulatory headwinds from China restrictions. Broadcom must successfully integrate VMware and manage substantial acquisition debt. Meta confronts severe regulatory pressure, with the FTC seeking Instagram talks WhatsApp divestiture, while Reality Labs continues burning billions annually. CrowdStrike's extreme valuation leaves no room for execution missteps. All these AI stocks remain vulnerable to broader economic downturns, potential AI spending cyclicality, and the technology sector's inherent volatility. Never invest without considering these counterbalances to the growth thesis. If you're finding this analysis of AI stocks to buy valuable, supporting the channel with a like or subscription helps me continue delivering this in-depth research. Your engagement directly influences what topics I cover next, especially in the rapidly evolving AI investment landscape. The current AI correction offers rare buying opportunities in market leaders. Nvidia and Broadcom present compelling hardware infrastructure plays, while Meta offers core business strength with AI optionality at reasonable multiples. For diversified exposure, consider QQQM. Market fear has created disconnects between price and value in these AI stocks best positioned for long-term growth, while the fundamental AI thesis remains intact. This transformative technology is still in early stages with an expanding TAM. When sentiment shifts, these discounts will likely vanish. Until next time, this is Harry Bullrun, reminding you that the best investment you can make is in you.